Thank you everyone for being here with us today as we conduct a review on the St. James's Place Asia portfolios in Q3 this year. My name is Elson Goh, Head of Asia Portfolio Management in St. James's Place, Singapore. In general, the last quarter has been a tough quarter for most assets. Inflation concerns, the Federal Reserve tapering on bond purchases, and the news of Evergrande has grabbed headlines in the last quarter, leading to higher market volatility, especially in September. Asia Pacific and emerging market equities have been the hardest hit over the last quarter. So as we can see from the performance tables here, our model portfolios had generated positive performances in sterling pound terms, but negative in US dollar terms and in Sing dollar terms. This is due to sterling pounds weakening across most major currencies, and therefore an internationally diversified portfolio will have a higher return when it is rebased in a currency that has weakened. Using US dollar and the US dollar portfolios as the focal point here, the conservative portfolio delivered minus 0.9% in Q3. The balanced portfolio delivered minus 1.4%. The managed portfolio delivered minus 1.4% as well. While the full equity portfolio, the adventurous portfolio, delivered minus 1.7% in US dollar terms, and it's net of all fees. The negative returns are largely attributable to the challenging market environment in Q3 due to inflation concerns and China credit issues. The portfolios in general also have a slight overweight tilt towards the Asia Pacific region, which explains the negative returns for the quarter as well. However, when you look across the 1 and 3 year time frame, the portfolios had generated very strong positive returns. As we investigate the performance attribution, I will share what went well and what did not go too well within the portfolios. So firstly, what went well in the growth model portfolios, and within the fixed income space, just to start, broadly speaking, the fixed income as an asset class has been in a challenging environment with inflation concerns and monetary tightening looming. However, most of the bond funds within the portfolio, which are predominantly in the lower and lower medium risk or medium risk portfolios, had done well year to date. We saw negative performances from most of the fixed income funds in Q3, but year to date, funds such as corporate bond, global high yield bond, and diversified bond delivered positive returns. And this is largely attributable to their higher exposure to higher bonds within their portfolio. Strong active management from the managers also contributed to the performance in the bond funds. The global high yield bond has part of its mandate to be invested into emerging market debt. And with that, Chinese property developers were one of the exposures within the portfolio. However, with strong active management, the manager trimmed its position in Chinese property developers, including Evergrande, from as early as May this year. Therefore, the impact from Evergrande was minimal within the portfolios. And then on the equities front, despite the volatility in the market in the last quarter, funds such as Global Quality and Global Value contributed positively to the performance of the portfolio. Over the last quarter, there was a slight rotation within the equity market, and we saw this happen in the third quarter as markets grew more wary of fast-growing companies in sectors such as technology, therefore rotating instead towards so-called value companies in sectors such as banking or energy. As a result, funds such as Global Value had benefited from the rotation. And just to note, both Global Quality and Global Value are included in all of the global growth model portfolios in Singapore. We also saw great performance once again from emerging markets equity, and it's contributing positively to the returns in the balanced, managed, and adventurous portfolios. This fund had been the best performing fund for the last 2 years, and the strong performance in the last quarter can be attributed to an underweight in China. Despite the underperformance from Asian equities, the Asia Pacific fund also held up relatively well. And then within the full equity adventurous portfolio, the Japan and the North American fund contributed positively to the performance as part of the value-oriented strategies worked well in the last quarter. So what did not go too well in the growth model portfolios? So in general, smaller cap stocks underperformed in Q3. The Global Smaller Companies Fund, which has a small 5% allocation in the adventurous portfolio, underperformed the broad market in the last quarter. Another fund, which underperformed in the last quarter, was the International Equity Fund. Just to add, this fund has a great track record, but it underperformed in the last quarter with its overweight positioning in technology and communications. And over the longer term, this fund has actually delivered strong risk-adjusted returns for our clients, and it is included in all of the growth model portfolios. So this marks the end of the review of the growth model portfolios, and I hope that it has provided you with some great insights to the portfolio and how they are doing.